Hi, it's Andrew with the Market Mindset. We're doing a reaction video today to Bloomberg Television, and we've got Torsten Slok, who is the Apollo Global Management Chief Economist. I think this is a useful video to take a look at because it's going to give a bit of a sobering thoughts upon the great news of Nvidia. Let's get to the video, and we'll talk about some extras that I saw in another clip as well that we won't show.
That single name, 240% plus gains year to date on Nvidia. The commentary on the south side, Evercore, just another run-of-the-mill blowout quarter for Nvidia. Bloomberg Intelligence, Nvidia's third straight double-digit percentage beat of sales consensus this year, and they raised. Torsten, you put out a note in the last week. It wasn't about mega cap tech, it was about small caps. 40% of the companies on the Russell, negative earnings. Torsten, how unusual is that?
That is really unusual. I mean, what the big picture really here is that everything that's going on in the tech world, it doesn't happen in a vacuum.
Just pause there for a second. Just before Torsten speaks, I guess his view on that. That's a lot of no earnings, but remember a lot of tech companies never have earnings. Kind of the laugh was that they just go for growth and they don't actually make money. I'm being facetious, but really, that can't happen. What this is highlighting, though, and it's what we've talked about before, is that most of the companies aren't doing so well out there. And I don't mean just the average Joe. We're seeing a lot of delinquency rates on credit cards. We're seeing bankruptcies. We're seeing all of this just in the economy. But your major companies aren't necessarily doing that well. It's only these couple of high-tech companies, and basically that are attached with AI, that are doing well. And they're leaning on that for being pretty much everything. But let's hear what Torsten has to say.
What's very critical about this situation is that we still have the Fed having rates at very high levels at the moment. And that's certainly having a negative impact across the board on companies that have no cash flows. So that's why even the forward PE for Nvidia is, of course, also heavily dependent on whether we will have that slowdown that the Fed is trying to engineer. So I look at this from the broadest perspective of, well, the Fed is still trying to slow the economy down. And with that backdrop, it actually makes more sense to look at the trailing PE. And the trailing PE of the Magnificent Seven is about 50. So that also still leads you to the conclusion that these things are still, in my view, quite heavily overvalued.
Torsten, how challenged are things going to get for the smaller numbers, the smaller names, the smaller companies, given that we just had jobless claims at 209?
Okay, pause there. So you have to remember the average PE is, but I think it's 16, 17 P ratio. 50 is exceptionally high. People are really factoring in what AI can do. Now, take nothing away from Nvidia's numbers. Those are amazing. It's incredible. And there is a lot of promise with all of the AI. And like Morningstar put out today, is that they're just not sure how to evaluate this because the impact is hard to tell. Now, they're going to run into impact problems because who's going to be able to afford all their products and services? All these other companies aren't doing that well. And because a couple companies are really driving things forward, that's the last thing you want for quote unquote an economy, is that it's a few companies doing exceptionally well and everyone else doing very poorly. You want to see a robustness in the economy, not just a couple high flyers that are really pulling up the rest of the quote unquote economy. And once again, there's a large distinction between who they're talking about and their clients, and then your average person. And we've talked about that in other videos, but that's something to keep in mind.
Unemployment south of 4%. We just had a quarter of GDP growth close to 5%, and you've still got 40% of the companies on the Russell with negative earnings.
That is what's so incredible, Jonathan, namely that how can companies not make money if this supposedly is a booming economy? And if I type ECFC Go on my Bloomberg screen and look at what the consensus expects for the next 3 quarters, GDP growth is going to be basically 0.5% for the next 9 months. So with that backdrop, this expectation that everything will still be fine for the next 6-12 months, I think that's completely misguided. The Fed is trying to slow the economy down to get inflation to come down. And with that backdrop, we should expect rates higher for longer. So there's just a missing conversation about rates are actually going to still continue to have a negative impact on companies with high leverage, with low coverage ratios, and with generally weak cash flows. So
let's pause there. I mean, a lot there. And even Goldman Sachs' outlook for next year is quite subdued. I mean, it's positive. It's not negative, but it's very subdued. And this is the disconnect that people that are actually doing analyst work are having And I'm surprised he's on, because generally speaking, when we see most of the commentators, it's to tell you about how great the market is and how great the economy is. And we've gone through some of the numbers before. If you actually look at the numbers, and also look at the revised numbers after, and you look to see the participation rate, and you look to see where are these jobs. We know that the high paying jobs from your FANG and your banking are coming down. They're letting people go. But yes, lots of jobs in services, retail, hospitality. But that's not a glowing sign. What you need to be looking at is whenever tax revenue comes in, is I suspect there'll be a large drop in tax revenue, because it won't match the higher paying jobs that were once out there. But let's take a look here at Torsten.
I still think that high rates are going to have a negative impact on the economy, just like it's had on consumers, on corporates, and on banks. And I think that process continues.
Yeah, so I mean, these high rates, and you want to remember, these have shot up at a rapid pace. They're hard for companies to deal with. Now, being in Canada, looking at a lot of junior markets, their ability to raise capital is exceptionally difficult. I imagine even in the States right now, if you're looking at new projects to raise capital, it's exceptionally difficult. You look at the failure of NewScale with their SMR in Idaho. It was the cost associated had escalated so rapidly that they hadn't taken it into context, or hadn't considered it. Now, there's many factors with NewScale, but that was a legitimate complaint. Was inflation had grown so high, the cost of work, cost of materials, cost of everything is exceptionally high for these things. And that's something that we have to take very seriously. And once again, you can't print trillions and trillions and trillions of dollars and not have to pay the piper sometime. And at the end of the day, high inflation is just another way of just saying we've hired your tax bracket. And anyone who tries to tell me differently, that they haven't noticed the cost of whether it's energy, food, rent, any of these things in a major area of the city or in your country, we know that the data is out there. Anyways, not to be negative, there's lots of hope on the horizon. There's a lot more challenges, though. So always be cautious and be prudent. Leave me your thoughts and tell me what you think.